Hello and welcome to our conversation on variance analysis. In this session, our focus will be on the labor cost. So before we get into the labor cost variance, let us take an hypothetical situation. For example, this is an information about a company which has prepared the budget, and the budget shows the labor cost information for 1 unit of a product called X requires 10 hours of skilled workers at the rate of 200 per hour and 30 hours of unskilled workers at the rate of 80 per hour. So this is the budgeted information. So this has been created on the basis of their past performance. And actual performance during the month, they produce 500 units, and the relevant cost information is given here under. That skilled workers is equal to 4,000 hours, unskilled workers 20,000 hours. Skilled workers have been paid at the rate of 250 hours, and unskilled workers have been paid at 60 rupees per hour. We can see that the rate at which the workers have been paid is different. Obviously, there has to be some labor cost variance. So that's why in this session, we'll revisit labor cost variance by using this information about a situation where the labor consists of two different categories of workers, skilled workers and unskilled workers. But before we get into the calculations of the variances, let us also understand the framework of labor cost variance. So in this case, for example, the cost manager, the manager of the company, the production manager, normally they come together at the end of the month and undertake a review. Whenever there is a budget, the budgets are prepared, the actual information is compiled, actually is compared with the budget to derive the variance. So when in one such meeting, the plant manager says, happy to inform you all that the labor cost variance for the month is 0. But a finance intern says that the devil is in the details. So what does it mean? Maybe it is necessary to understand the various components of the labor cost variances. In order to examine the implications of the relevance of these two statements, let us understand the labor cost variance framework. We know that labor cost variance is a part of the total cost variance, which arises due to the change in the expected cost of labor and actual cost of labor. And the labor cost variance may arise due to the rate or the efficiency or the time. The labor cost is calculated as rate into time. So labor cost variance is because of the rate variance or efficiency variance. So there is a possibility at some time that LCV may be 0. But this LCV 0 does not mean that LRV and LEV will be 0. So it is necessary to decompose the labor cost variance. So labor cost variance can be classified or decomposed into labor rate and labor efficiency. The labor efficiency effect on the cost may be because of the change in the composition of the mix of the labor, the team composition. For example, in this case, the company was using two different categories of employees, skilled workers and unskilled workers. So there is a possibility the cost may change because of the composition of the employees. And the, the balance is treated as a net efficiency or yield variance. So labor cost variance may arise due to the change in the rate, change in the efficiency. The efficiency may change because of the composition of the team. And the remaining one can be called, the variance can be given a name as net efficiency or labor yield variance. Here, I'm not giving you the formulas here. We will see that in Excel calculation. Since labor efficiency is decomposed into LMV and LYE, we can also present the variances as labor cost variance may arise because of change in rate, change in the composition of the team, or the net efficiency, which is called the yield variance. So, in order to understand and examine the statements of the plant manager and the finance intern, as finance intern says that the devil is in the detail. So, it is necessary to calculate all possible variances. So, let us go to Excel to do that. So this is the standard information for one product, 10 hours of skilled workers and 30 hours of unskilled workers for one particular unit of X. But in a month, particular month, November, they produce 500 and the cost information regarding labor is given here. Any exercise on labor cost variance, for that matter, any variance analysis, it is always useful to prepare a working note. And the working note should help us in deriving the relevant variances. So the relevant variables required to calculate the variances is the standard time, standard rate, actual time, standard mix, actual rate, standard output, actual output, standard cost of labor per unit of output, and actual cost of labor per unit of output. So let me also put this as a per unit of output. Both are per unit of output. Whereas this rate is a rate of labor per hour. So standard time, by definition, is the expected time for actual output. For example, it says that 10 hours of skilled workers required to produce 1 unit. So for 500 units, the standard time required will be 5,000 units. For 1 unit, you require 10 hours. So the input-output ratio is 1:10. So 1 unit of output requires 10 hours. So 5,000 units will require 5,000 hours of skilled labor. Similarly, for semi-skilled, for 1 unit of output, it requires 30 hours. So 1:3. So 15,000 hours are required for 500 units. But what is the actual time spent? The actual time we can see 4,000 and 20,000 respectively. That itself shows that the budget or the standards and actual are not same. We already deviated from that. What is the rate? The rate at which the skilled workers were paid was 200, and unskilled are expected to be paid at 80. You can see that. Where the actual rate given is 250 and 60. So time has changed and also rate has changed. So now let us see whether the composition of the team has changed. The composition of the team says, as per the standard, 1:3. So the skilled workers should be 1/3 of the unskilled workers, or skilled workers should be 25% of the total labor force. Our actual time that we have used is 24,000, but definitely it is not in the ratio of the standard expected ratio. So they have not only used more time, but they've also changed the composition. What is composition? The standard mix is actual time in the standard ratio. Actual time in standard ratio. What does it mean? If you have used more time, no problem. But why don't you use in the same ratio, same composition? So it should have been in the ratio of 1:3, but we have used 4,000 and 20,000 respectively. So to summarize once again, time has changed, hours consumed and expected has changed, the rate has changed, the expected rate and actual rate has changed, and also the mix has changed, the composition of the team has changed. We have used less of skilled workers and more of unskilled workers. Obviously, there will be some cost variance. Before we calculate that, let us also find the given is actual output 500. What is the standard output? What is standard output? Is the expected output from actual input. The actual input is 24,000 hours. So it says 40 hours are required to produce 1 unit. So therefore, for 24,000 hours, our production should have been 600 units, but you produced 500 units. So this is also a reflection of inefficiency. Is the inefficiency because of the rate? Is the inefficiency because of the mix? Is inefficiency because of some reasons which are beyond the explanation of information available here? Then the actual cost of labor per unit of output, actual cost of labor per unit of output is equal to 4,400. How did we get that? You can see that 4,000 units of skill, 4,000 hours of skilled workers, 20,000 hours of unskilled workers at 250 and 60 respectively. So the total labor cost is 2.2 million, and the actual output is equal to 500. So the standard actual cost of labor per unit of output is 4,400. What is this 4,400? Once again, it is the cost of labor per unit of output. But what is this 200? This is the cost of labor per labor hour. This is the cost of input. This is the cost of output. What should have been the standard cost of labor per unit of output? The standard cost of labor per unit of output is also 4,400. You can see that. So how did this 4,400 come? 10 hours, 10 workers working for 200 hours, 30 hours working for at the rate of 80 per hour, 10 hours working at the rate of 200 per hour, and 30 hours at the rate of 80. 4,400 is a cost for 1 unit of output. So standard cost of labor per unit of output is 4,400. The actual cost of labor per unit of output is 4,000. So the plant manager may be saying at this level that there is no labor cost variance, because we thought we'll spend 4,400 per unit of output, and we have actually spent 4,400 rupees per unit of output. But it is always useful to understand the composition of this labor cost variances. So let us undertake a detailed analysis as we mentioned here. Labor cost variance is because of the rate variance and efficiency variance, and efficiency variance is because of the mix variance and the yield variance. So LCV may be zero. That's what we can see here. LCV is equal to, so all that we are going to do now is to calculate all possible variances using this framework. So what all we need? We need to find labor cost variance, labor rate variance, labor efficiency variance, labor mix variance, and labor yield variance. And while doing that, I'll also explain the formula. So labor cost variance is standard cost of labor minus the actual cost of labor. Standard cost of labor minus the actual cost of labor. Standard cost of labor is standard time into standard rate. Standard time into standard rate. That means they create some space for us. So standard cost of labor is equal to ST into SR. And that is equal to, okay, that is equal to 1 million for the skilled workers. The actual cost of labor is 1 million. So therefore, there is no variance at this level. What about the unskilled workers? Unskilled workers also there is no. So overall, cost variance is 0. And that's what the plant manager says. But observe that there is a change in the rate, there is a change in time, there is a change in output. To undertake a comprehensive labor cost variances for managerial decisions, don't stop the variance analysis at this level. So rate variance is a part of the cost variance which arises due to the change in the labor rate. And there is a change in the labor rate here. There is a change in the labor rate. The labor rate the change is because of the money that we paid here. We can see that for skilled workers, we have paid more, 200 to 50. For skilled workers, we paid more. For unskilled workers, per hour, we paid less. So this labor rate variance is equal to standard rate minus actual rate into actual time paid. So the total labor rate variance is equal to 200,000 favorable. That means the rate variance has positively affected the labor cost variance. Then we may ask a question at this level. How come then the labor cost variance is 0? It's possible, it's visible that labor cost variance is 0 because there has to be an inefficiency in the system. And that can be derived by examining the labor efficiency variance. Labor efficiency variance is the standard time minus actual time into standard rate. Standard time minus actual time into standard rate. And that also, it is always advisable to find for each component, okay, for each type of labor. Wherever there is a cost variances, for every input we should find. That's why variance analysis become meaningful. So standard time minus actual time, we can see that there is a positive variance with respect to the skilled workers. That means I've used less time for the skilled workers. So there is a favorable 200. But unskilled workers, we have used more unskilled workers, so there is an adverse variance. Overall, we can see that overall there is a adverse variance to the extent of 200,000 adverse. So the favorable rate variance plus unfavorable efficiency variance become zero labor cost variance, right? Becomes zero labor cost variance. So labor cost variance is zero. Why? The benefits of rate variance has been nullified by the efficiency variance, or vice versa. Our efficiency is poor because we paid less. Favorable variance of rate means we paid less. But we don't want to stop here. We want to find out, did the cost change because of the mix? Or is it because of the net efficiency variance? The mix variance shows change in the labor cost due to the change in the composition. We already know that the composition has changed. Actually, we were supposed to have used 6,000 and 18,000, but we have used 4,000 and 20,000. So expected ratio of the actual input. So mix variance is a part of the labor cost variance, which arises due to the change in the mix. So mix variance of skilled workers is positive. That means I've used less of skilled workers. So don't always think about the positive variance means positive into spirit. So I've used less of skilled workers. Because I've used less of skilled workers, there is a positive skilled workers mix variance. But what about the unskilled workers? The unskilled workers, there's a huge negative, and overall, therefore, overall, there is a mix variance as responsible for, okay, because you have used more of unskilled workers and less of skilled workers. Overall, there is a favorable effect of the mix. But as I mentioned, the variances can be calculated in isolation. Don't interpret them in isolation. Is favorable labor mix is always good, or depends on the overall effect? We can see that overall efficiency is negative, adverse. Okay. And this can also be examined through the yield variance, net effect. The net effect we can see the efficiency variance is because of the mix variance and yield variance. So by default, yield variance will be efficiency minus mix, but it's always advisable to find on the basis of the output, actual output minus the standard output into standard cost of labor. The actual output is 500. Actual output is 500. With the same input, we were supposed to have manufactured 600. So there is inefficiency in the system. Removing the mix effect, mix impact of the mix, the efficiency variance due to the net effect of efficiency is captured in the yield variance. So therefore, the mix come yield variance plus yield variance is the cost variance. You can see that there is a huge amount of yield variance adverse. That's what I mentioned. It's possible that your mix variance is favorable because you have used more of unskilled workers, sorry. And because you have used more of unskilled workers, overall efficiency has gone down. So you produce less in a given time. So we can observe cost variance may be zero, but there is a rate variance, there is efficiency variance, there is mix variance, there is yield variance. So if we go back to the exercise question there, the conversation, the plant manager says the cost variance is 0. Whereas the intern says the devil is in the detail. So what does that mean? Both are right in one way. The plant manager is talking at this level, but the intern is of view that don't stop your analysis at this level. Examine the details. So labor cost variance may arise because of the rate or efficiency or mix or the net efficiency variances. So it is always advisable, therefore, to find the overall, before we comment on the overall performance of a company, it is always advisable to examine the all components of the variances. Otherwise, we will not do justice to the entire process of variance analysis. So LCV, therefore, is because of LRV and LEV, and LEV is because of LMV and LY. So in principle, don't stop the analysis of the variances at LCV level. Thank you very much.